Welcome from me, Guy Munson, to Saracen's regular 6-minute strategy. Despite today's extraordinary array of political challenges, including rapidly escalating missile attacks in the Gulf and increasing Russian advances in Ukraine, global asset markets still delivered unexpectedly strong returns in the third quarter of 2024. Bonds, equities and commodities all posted gains, while equity volatility fell back last month to near its lows for the quarter. In short, global markets have largely been ignoring today's worsening geopolitics, one that includes, of course, a pivotal US election next month. Instead, they've chosen to focus on a remarkable soft landing of the American economy, lower inflation globally, and most recently, a long-awaited Chinese stimulus package. So for how long can markets continue to shrug off the worsening geopolitics is a question we will be asking in the slides ahead. So let's begin by looking at the performance of world equity markets in the third quarter. That's the shaded block. In the left-hand panel, you can see the dark blue line, that's world equities, rising modestly on the quarter. But that very strong turnaround in the red line, that's world equities equally weighted. That's where you equally weight some of these tech supercaps to the rest of the index. What, of course, that means is that leadership is broadening away from the Mag 7 to a more diverse range of industries and companies, and that's good. On the right-hand panel, a similar message. If you look at the style leadership of the global equity index, momentum is still reasonably powerful, but growth, value and dividend yield beginning to converge again as market leadership broadens. So why were markets so resilient in the face of geopolitics, and can this continue? Well, I think the first point is that the volatility numbers are remaining relatively attractive. In that left-hand panel, you can see the surge in volatility, the VIX index, at the beginning of the Ukrainian war. You can see a tick up at the beginning of Israeli-Hamas war, and then that sharp peak in August, and that was the sell-off in Mag 7. It wasn't the geopolitics. So it would seem that equity volatility is relatively protected from geopolitical trends. Look at other assets, you get a similar message for the year to date. The dollar is flat, no flight to the US currency. Oil markets are flat despite the uptick of the last few days. Only gold is really surging strongly, and that's probably precautionary buying by emerging market central banks. The second reason is that I think as we've got more used to the leadership of the AI and the market and the Mag 7 components of the index, we can see too that while they may not lead going forward, they actually are underpinned by very strong fundamentals. This shows the Mag 7 as at the end of August 2024 and shows that it accounted for 25%, or in fact slightly in excess of that, of the S&P 500. But it also accounted for nearly 20% of free cash flow, nearly 30% of R&D expense, and nearly 20% of operating earnings. In other words, the levels of the real world and the stock market were relatively low adjusted. And I think this gives us confidence that a change in leadership in the Mag 7 will not necessarily be violent. By the way, my thanks to our empirical research partners who give us such valuable advice here at Saracen. I think the third reason markets have proved resilient is that the big US soft landing, which has been the theme of so much of our talks, continues really unabated. In the left-hand side, you can see that US labour supply and demand are coming nicely back into balance. Non-farm payrolls are affecting the longer-term average. And the personal consumption deflator, which is the Federal Reserve's preferred measure of inflation, continues to come down, settling at 2.7% today. That, of course, gave Chairman Jerome Powell the confidence to cut rates by a whopping 50 basis points. And look on the right hand there at what this has done for the futures market's projected interest rates to the end of 2025. Just 12 weeks ago, they were nearly 4%. Today, they're around 2.9%. So that much more benign interest rate backdrop, of course, helping asset prices. Finally, we saw something we badly needed, which was a big Chinese stimulus plan. We've been worrying on the left-hand panel on many of these talks about the worsening the Chinese real estate market. You can see completions continuing to fall, construction starts strongly negative, a little bit of bounce of floor space under correction. But what was beginning to look like a real Japanese-style property-led deflation. Now, the package we saw last week hasn't covered everything, but it is a step in the right direction. Central bank rates have been cut, banks recapitalised, housing measures to rescue some of the local stock of unsold homes have been put in place, and a modest fiscal package for about 1.5% of GDP. In addition, of course, we've seen a big help with the Chinese stock market, which has rallied strongly. Now, we probably need to see more of a fiscal response. I don't think this alone is enough to avert the deflationary pressures, but it's a step in the right direction. So let's wrap up by looking at a chart from the famous Bank of America Fund Manager Survey, where they asked investors the question, what do you consider the biggest tail risk? Now, look at that 3 months ago, and the answer was clearly geopolitical conflict. The answer today, though, is US recession. In other words, it seems to be that investors are getting a little bit more confident about managing the geopolitical risks around the world in their portfolios. And you can see why on the right-hand panel, because despite the terrible human cost, there hasn't actually been much economic cost at a global level from these conflicts. Yes, with Israel and Hamas, that would change if Iran, for example, was to constrict shipping through the Straits of Hormuz and tanker traffic. It would change, of course, if there was any threat in the Russia-Ukraine conflict to use even limited nuclear weapons. In the US, probably the biggest risk lies in a Trump clean sweep, where he takes the House and Senate and has really enormous power over implementation of aggressive tariffs and tax cuts. Put those all together, though, what can you do in your portfolio to make yourself more robust without dramatically changing asset allocation? Well, I'd make sure you have exposure to gold, that you have thematic equities where the earnings are underpinned by longer term trends, not just cyclical moves, that you embed ESG into your portfolio so you're robust against climate change, deploy portfolio insurance where you can, and emphasize liquidity across equities and bonds so if conditions do worsen, you're able to move and respond. Well, thank you very much. I hope the guidelines I've shown are useful, and in the meanwhile, let's hope that the terrible human cost of these events begins to abate.